Did you know Nestle is the largest food company in the world by market cap? Today's video will be an in-depth analysis of Nestle stock. We'll look at how and where Nestle generates revenue, key financial metrics, and technical analysis in order to determine if now is a favorable time to buy. The first aspect of a business I like to evaluate is which products and operating segments they generate revenue from to determine the foundation of the business. Nestle clearly displays this on their annual review, which is shown in Swiss francs or CHF. Their leading business segment at $24.8 billion is powdered and liquid beverages, which contains popular products such as Nescafé and Milo, which represents 27% of total revenue. The next largest segment is pet care at 20% of revenue. This was surprising to me as I didn't even know Nestle had pet food or pet products, and it turns out it's their second largest business segment. This segment has products predominantly under the brand Purina and offers a slew of options. Then there's nutrition and health science at 16% of revenue, with big brands like Nature's Bounty and Gerber. The next largest segment is prepared dishes and cooking aids, which offers things like not so delicious DiGiorno and the very hot Pockets at 13% of revenue. The last two large segments are milk products and ice cream at 12% of revenue, and confectionery or candy at 9% of revenue. And their final and smallest business segment at 4% of revenue is water. They are also developing new products such as N3, which is a milk product with lower lactose and a prebiotic component. Their total R&D budget in 2023 was 1.7 billion francs, which makes up 2% of their revenue. Although they have many products in R&D, given that their total revenue is so large comparatively, it will probably take many new products to move their revenue needle significantly. Additionally, they are making negligible acquisitions, which we can see here in 2023, were only $211 million, or less than 1% of total revenue. Here we see how Nestle breaks down their revenue by region, and the largest segment by a significant margin is North America at 35% of revenue, followed by Europe at 24% of sales, Africa, Australia, and the rest of Asia, excluding China, at 21%. Latin America at 14% of sales, and lastly, a segment titled Greater China gets its own segment at 6% of revenue, which includes Taiwan. I've seen a few other companies that also include China and Taiwan in one segment, and I wonder if they're attempting to be in China's good graces. Upon seeing this, it led me to Google search how many countries formally recognize Taiwan's sovereignty, and surprisingly, there are only 13 countries that do. Now let's cover the macro-level benefits, or pros, of buying into Nestle. The most obvious pro that pops into my mind is that they sell food. We all need food, and they will continue to sell their essential products, even through recessions. Another more subtle pro is that they are a familiar brand. Brand familiarity leads to return customers. Additionally, Nestle is known for making quality products. If you've ever traveled through Southeast Asia and drank instant coffee, you'd know Nestle is the gold standard, which is just one example of their level of quality and representation of their brand. Lastly, they are virtually everywhere. They operate in 188 countries globally and offer more than 2,000 products. Plus, they operate in so many different food categories, they are basically a food ETF. Nestle will likely outlive us all, and they are a company that you could truly buy and hold forever. Now let's consider the cons of buying into Nestle. The most prominent con for a company of this scale is lack of growth. Being that they are so well established and operate in so many countries, it's difficult to expand into new markets or product categories. This can be seen through their revenue on a non-per-share basis, which has barely grown over the past 10 years to the trailing 12 months, only moving from 91.9 to 93.4 billion, or a CAGR of 0.16%. Furthermore, food businesses are generally slow growing and are typically low-margin businesses. Here we can see revenue from Mondelez, another massive food company, whose revenue has also barely grown over 10 years. So food, although it is essential, it's not an ideal investment category for growth investors. The first fundamental metric we'll look at is revenue, since it is the foundation of a business. Here we see revenue over the past 10 years in billions of dollars, which has only grown by a CAGR of 0.2%. But if you look to the left, you can see that shares outstanding are declining at a meaningful rate. And just as an example of how revenue per share can be misleading as compared to absolute revenue numbers, here is the revenue per share growth rate, which is a much more presentable 2.2%. If we compare Nestle's 10-year growth rate to some of its peers, Pepsi and Mondelez, accounting for scale and diversity of food products, we see Pepsi has grown their revenue substantially faster, at a 10-year CAGR of 3.2%. And Mondelez has also grown their revenue at a snail's pace like Nestle at a rate of 0.5%. So Nestle gets a negative rating in the revenue category, being the laggard of the group. Next, we see Nestle's earnings per share over the past 10 years, which has grown from $3.44 per share to $4.80 per share, or a CAGR of 3.4%. Over a 5-year period, though, their earnings have slowed significantly to a 5-year CAGR of only 1.7%. Compared to Pepsi, Nestle's earnings look even worse, whose earnings have grown by a 10-year CAGR of 5.1% and a 5-year CAGR of 6.6%. And Mondelez's 10-year to the trailing 12 months growth is even better, at 6.4%, while the 5-year CAGR is 5.7%. So Nestle gets a negative rating here, losing to its peers in both the 10 and 5-year periods. Next, we have free cash flow per share over 10 years, which is even worse than revenue, and EPS, having grown by only 1.3%. Over a 5-year period, their growth is negative, at a decline of 1.5%, while Pepsi's growth over a 10-year period was also poor at 1.3%, while their 5-year growth has accelerated substantially to a CAGR of 8.3%. While Mondelez is dominating in terms of free cash flow with an outstanding 10-year growth rate of 8.8% and a 5-year growth rate of 4.7%, which we'll see later is partly due to share buybacks and a low dividend payout ratio. So again, Nestle loses to both of its peers. Next, we have cash and short-term investments over 10 years, which for Nestle has shrunk by a CAGR of 1.6% and is currently at $7 billion. If we go over to their total liabilities, which are currently at $107 billion, and we add back their cash, they have a true liability level of $100 billion. If we compare that to their 2023 net income of $12.5 billion, they have a total liability to net income level of 8 times, meaning that it would take 8 years of net income to equal their total liability level, assuming no growth in net income. If we compare that to Pepsi using the same process, Pepsi almost has an identical liability to net income level of 7.9 times. Weirder still, Mondelez also has a true liability to net income level of 8.2 times. So Nestle gets a neutral rating here, having a nearly identical liability to net income level as its peers. Now we see shares outstanding over 10 years, which has shrunk by a meaningful 1.9% annualized. And if we flash back to earnings per share, which has grown by 3.4%, we can see that share buybacks have made up the majority of their EPS growth, meaning their true net income is growing at a snail's pace. Compared to Pepsi, Nestle is dominating in terms of share buybacks with a CAGR of negative 1.0%, beating out Pepsi by 47%. Lastly, we see Mondelez, which leads the pack, reducing their shares by a CAGR of 2.2%, or a total reduction of 20% over this period. So in the share buyback category, Nestle gets a neutral rating, beating Pepsi substantially and losing to Mondelez. Now we're going to look at dividends, starting with the payout ratio, using free cash flow over 10 years. Nestle has a high payout ratio average of 79%, while Pepsi's payout ratio is slightly lower at an average of 77%. And lastly, we have Mondelez, with a much lower payout ratio average of only 59%. So the compounding effect of EPS and dividend growth through share buybacks and a low payout ratio has the opportunity to be much higher for a company like Mondelez as compared to Nestle or Pepsi, just through their allocation of capital. So Nestle gets another negative rating in the dividend payout ratio category, losing to both of its peers. Next, we have the dividend growth rates. Nestle's 10-year dividend growth rate is a low 4.4%, and their 5-year growth rate is much higher at 6.5%. Next, we have Pepsi with a commendable 10-year growth rate of 8.4% and a 5-year growth rate of 6.4%. And we see the growth patterns are inverse for Pepsi compared to Nestle, with Nestle's 5-year growth being higher, while Pepsi's 10-year growth is higher. Which do you think is preferable? Lastly, we see Mondelez, and the dividend story is complete. Since Mondelez isn't using all of their capital to pay their dividend, they can grow their dividend faster, which is a function of meaningful share buybacks and a low payout ratio, making their growth rates the highest of the group, with a 10-year growth rate of 11.6% and a 5-year growth rate of 11%. So Nestle loses in the dividend growth category, having the smallest growth rate over a 10-year period and barely beats out Pepsi's 5-year growth. The last metric we want to look at before looking at the current yield is dividend consistency. Here we see Nestle's dividend distribution since 2003 in Swiss francs, which has been growing uninterrupted for 23 years. Although if we look at the dividend history on Seeking Alpha, the dividend appears inconsistent, and that's because Seeking Alpha shows their data in USD, while Simply Safe Dividends shows their dividend in the native currency, Swiss francs. One more thing is that Nestle pays an annual dividend, so it would require more intentional budgeting if you intended to live off the stock. Next, we have Pepsi, which is one of the dividend kings, as they've grown their dividend for 51 consecutive years, which is pretty incredible. But how long can the growth last? We can see that in 2003, their payout ratio based on free cash flow was only 37%. And in 2023, their payout ratio has climbed all the way to 86%. If the trend continued of growing their dividend through increasing the payout ratio, in 20 years, they'd be paying out more than their earnings, which they won't. Lastly, we have Mondelez, which has had quite a variable dividend over 20 years. But in the last 10, they have shaped up and have been increasing their dividend consecutively for the last 10 years. And again, they have the lowest payout ratio of the group. So Nestle gets a neutral rating in the dividend consistency category, having a more consistent dividend than Mondelez, but inconsistent compared to Pepsi. The final dividend metric we see is the dividend yield, with Nestle having a trailing 12 months yield of 3.1%, which is 24% above its own 5-year average yield of 2.5%. Next, we have Pepsi, who also has a dividend yield of 3.1%, which is 13.3% above its own 5-year average of 2.7%. Lastly, we have Mondelez with the lowest dividend yield of 2.3%, which is 7% above its 5-year average of 2.1%. All of these stocks aren't yielding much, but their dividends will likely continue long into the future as they sell more or less essential products and have consistent earnings. So Nestle gets another neutral rating, having the same yield as Pepsi and a much higher yield than Mondelez. Now we'll go over some fundamental metrics related to price, starting with the price to earnings ratio. Here we see Nestle's forward PE ratio of 18.7 compared to the 5-year average PE of 22.9, which is a discount of 18%. We also see that Nestle has never traded at this low of a valuation in the last 5 years, probably indicating a favorable time to buy. I would use Seeking Alpha for this data since they use a trailing 12-month PE, but they don't currently have the 5-year average for Nestle. Now we see Pepsi with a forward PE of 20, which is a 16.7% discount compared to its 5-year average of 24, which is near a 5-year valuation low, which hasn't happened since the crash of 2020. Lastly, we see Mondelez with a PE of 20.4, which is only a 3.3% discount based on its 5-year average PE of 21.1. We can also see that the normal valuation trading range for Mondelez is much tighter, so each of these companies are trading at a discount compared to themselves. But what about compared to the consumer staples sector in general? Here we see the consumer staples ETF, XLP, and we see that the average PE ratio is 25.6, which is substantially higher than each one of these companies, and likely indicates value for the group. So in terms of value, Nestle finally wins the category being the cheapest, which makes sense as the market is accounting for their ill performance in all the other categories. Before we go on to the technical analysis, let's check out the side-by-side total return of these three companies. Here we see the three companies and the largest S&P 500 ETF by market cap, VOO, over a 5-year period. The first thing to note is each of them have underperformed the S&P, but we could look at that as a possible market rotation that is yet to come and possible value. Leading the pack is Mondelez with a return of 72%, which makes sense since they're buying back shares quickly while growing their fundamentals, followed by Pepsi at 63%. And far behind is Nestle at a total return of 32%. So in summary of the fundamental analysis of Nestle compared to its peers, Nestle is a stable company, but is very slow growing in basically every category and doesn't excel in any category we looked at. I think the only value for Nestle would be if you wanted to own a piece of a worldwide and iconic brand, or to buy the stock with little potential for downside and the possibility of valuation moving back to fair value. The company that I like the best in this group is Mondelez, since they are growing their fundamentals fairly quickly, along with their dividend, buying back shares at a meaningful rate, and they have a low payout ratio, which will lead to more share buybacks, business growth, and dividend growth. Let me know which company you think is the most buy-worthy. Here we see a 5-year price chart for Nestle. The first aspect I like to identify is the price trend, and it's in a clear uptrend. Next, we can see the standard deviation channel, which is a tool that enables us to determine how far price is from average given a particular time frame, with the average being depicted by the center yellow line. Currently, the price is relatively far from average, roughly 16%. Additionally, the price just bounced off the lower standard deviation channel, which is often a point of reversal. In terms of support and resistance, the recent reversal also coalesced with a support level around $103, which is the 2-year low, and price has recently found resistance right where you would expect at $107. Lastly, the relative strength index graphed at the bottom of the chart also found a bottom and a likely reversal point, and is currently still at a good buying point, being that it is near the bottom of the channel. But if we switch to a 10-year time frame, the patterns are the same. The price is well below the standard deviation compared to its own history, and the RSI indicates a favorable buying point. Now we see Pepsi over 5 years, which is also in a clear uptrend and below average, or about 14% below average for this period. The price is nearing a solid support level around $160, but an even more established support level is at $155, and the next most likely resistance level is around $170, but that resistance level is less defined than the support levels. In terms of the RSI, it is still near the bottom of the channel, but we recently missed the true bottom indicated with the buy signal on October 30th. From a 10-year perspective, we see that the price isn't too variable or deviating from average. And if you didn't know, Pepsi has an extremely low beta of 0.36. Meaning it is far less volatile than the S&P 500. We also see that the price is still above the EMA, which acts as a support level, whereas price was below the EMA for Nestle, and the RSI is indicating a favorable time to buy, being at a relative low. Lastly, we see Mondelez over 5 years on a clear uptrend, and they're basically right at the center standard deviation line, or average price, not indicating exceptional value. Price recently found resistance near the all-time high and is finding support again off the 90 EMA line. Recently, though, the price had a huge bounce around $60, which coincided with a buy signal from the RSI on October 16th. And currently, the RSI indicates a disadvantageous buying point. From a 10-year standpoint, the price is above the 10-year standard deviation, and the RSI shows the stock is at a fair value when looking at the historical RSI data, as opposed to the objective scale. Since these stocks trade within the consumer staples sector, it will be partially governed by what it does. So here we see the Consumer Staples ETF XLP over 5 years. It's below the average price, but only slightly, and is approaching the center standard deviation line, which often acts as resistance. Additionally, it is approaching an extremely prominent resistance level of $77. Furthermore, the RSI indicates that price is overbought and may be due for a reversal. From a 10-year standpoint, again, it is at the average price, although the RSI is not quite as overbought. In summary of the technical analysis, Nestle is at the best buying point, being very near the lower 5-year standard deviation line. It is close to a strong support level and is near a relative low according to the RSI. Pepsi is similarly at a favorable buying point for the same reasons, while Mondelez is technically not at a favorable buying point. Let me know which stock you think looks like a buy from a technical standpoint. Thank you for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.